Good morning and welcome to Economic Defense. I'd like to continue from the last time discussing safer bets for both inflation and a crash. And so I'm going to recap the fact that we are in the biggest bubble of all times, why I think nominal interest rates should rise, and why despite that the real interest rate might not, and what those two options might do. I'm going to remind you what Michael Burry has been rumored to do about inflation or crash, and then I'm going to offer a couple of possible tweaks. So this is the ratio of stock prices to GDP, which is at all-time high. So this is kind of the sign for a bubble. And regarding the nominal interest rate, I expect them to rise because the Federal Reserve already announced that they are going to reduce lending, and at the same time, the government is going to require more borrowing. And so, what we have here is a description of the market for loans, and on the y axis, we have the interest rate, on the x axis, we have the amount of lending, and we have a red line for the supply curve and a green line for the demand curve. The supply is provided by the Federal Reserve and the public, and the demand is required by the government. And so what we have is a shift to the left of the supply curve because of less lending by the Fed, and at the same time a shift to the right of the demand curve because of more borrowing by the government, and that should lead to an increase in nominal interest rates. At the same time, the Fed promised to keep the short-term interest rate low. So having less ammunition to intervene in the interest rate markets, the Fed would have to focus on the short end of the lending curve, and that would allow the longer duration loans to increase in interest rates. Despite that, the real interest rate might not rise. So the real interest rate is the difference between the nominal interest rate, less inflation. So we're starting at the start with very low nominal interest rate and high inflation, so the real interest rate is negative. So basically we are paying the government in order to lend them. And that is a situation that usually doesn't last very long. And so from here we can just go to the right with increasing nominal interest rate, but at the same time increasing inflation. So if they both increase at the same rate, then the real interest rate doesn't change. But if the nominal interest rate rises faster than inflation, then we have an increase in real interest rate, and at some point that would pop the bubble and cause a recession, and at that point the nominal interest rate would decrease again. And so what Michael Burry's play has been rumored to be, and Michael Burry is the guy from the Big Short, is that he is invested in defensive stocks. These are stocks of companies that have profits, pricing power, so that they can respond to inflation by increasing prices. He's been sent to short treasuries, and that is because higher nominal rates are basically equal to lower bond prices. And he's been rumored to short a disruptive technology ETF because higher nominal rates lead to more discounting, higher discounting of future profits. And for those companies that have profits way into the future, a lot of discounting reduces their valuation, and they're expected to sink in prices. And finally, he's been rumored to short Tesla. I think he closed that short already, but I'm assuming that that is a play on the green inflation, and I have a special slide for that. And so I think that what was missed is that in his play, the treasuries and the disruptive technology shorts work together to reduce volatility in a similar manner to how people usually combine bonds and stocks in portfolios to reduce volatility. The problem with that is that I think that usually in a case of a crash, treasuries increase in price because people sell their stocks and buy treasuries. And so that might be not the ideal defender against a crash. Instead, I think junk bonds are much more safe in that respect because they should sink both due to inflation, higher interest rates, and the crash. So that's a first tweak. The second tweak is regarding green inflation. We have a sudden demand for battery materials, and that is because all of the car manufacturers decided to switch from gasoline cars to electric vehicles at the same time, and there's an enormous demand for the materials that are required to make lithium ion batteries. And so, what I expect will happen is that will negatively affect the electric vehicles manufacturers and positively affect the battery materials manufacturers because the price of battery materials would rise, which would increase the margins of the battery material manufacturers at the same time that the quantity that they sell is rising. And at the same time, it would squeeze the margins of the producers of electric vehicles. And for those who still make gasoline cars that are not fuel efficient, they will also suffer sales on the gasoline side because of higher oil prices. So I think that the green inflation will have a negative effect on car producers and a positive effect on battery material manufacturers. In case of a crash, I expect for the same reason the electric vehicle manufacturers to do worse than the battery materials manufacturer. So if we combine a short or a negative view of electric vehicles with a long or a positive view of battery materials, we basically invert the arrows on the electric vehicle side, and now we have a combination that is going to do very well in a green inflation situation. And in the case of a crash, the negative view on electric vehicles is going to defend against depreciation in the battery material side of this bet. So this is the second week for today. And finally, I would like to remind you that this is not financial advice. This is for entertainment and educational purposes only. And please do not use this content without seeking the advice of a financial advisor. See you next time.